Hi looters, welcome back to Tick to Loot market updates for August 8th, 2026. I'm fired up to run through yesterday's numbers, today's calendar, and the headlines that are shaking the FX floor. First, a quick reminder. This video is for educational purposes only and is not financial advice. Markets carry risk. Always do your own research and consult a licensed financial advisor before making any trading decisions. Let's dive in. Let's start with what happened yesterday. The market saw a series of low-impact releases across Europe and Japan. While none of the data points were headline grabbers, they still gave us clues about underlying trends. In Japan, the leading indicators index was forecast at 116.5%, just a hair below the 116.8% from the prior period, hinting at a modest slowdown in momentum. Across the Eurozone, German industrial output was expected to grow only 0.2% month-over-month, a big drop from the 0.9% seen last month, suggesting weaker manufacturing activity. Those subtle shifts kept the euro a bit more cautious while the yen held steady. Focusing on the yen, the leading indicators forecast of 116.5% versus 116.8% previously signals a tiny easing in the factors that usually precede growth, things like factory orders and new business loans. Traders often watch this metric for early signs of a shift in monetary policy expectations. With the number nudging lower, the market may start to price in a slightly softer stance from the Bank of Japan, even though the impact rating remains low. Turning to Germany, the industrial production forecast of just 0.2% month-over-month is a stark slowdown from the 0.9% gain recorded previously. Analysts interpret this as a sign that the manufacturing sector is feeling the pinch from weaker global demand and higher energy costs. Even though the release is tagged low impact, it adds to a broader narrative of a cooling German economy, which can subtly influence the euro's trajectory against its peers. The German trade balance also came out with a forecast of a 17.2 billion euro surplus, down from a 19.1 billion euro surplus in the prior period. A narrowing surplus suggests that exports may be losing steam or imports are picking up, both of which can weigh on the euro. While the market didn't react dramatically, it's a data point that reinforces the picture of a modestly softer German economy. Across the pond, Lloyd's released its house price index forecast at 0.2% month-over-month, matching the previous reading. A flatlined HPI suggests that UK housing price growth is holding steady, which can be a neutral factor for the pound. Since the impact rating is low, traders are likely to keep their focus elsewhere, but the data still provides a snapshot of domestic demand. France's trade balance forecast came in at a deficit of 6.5 billion euros, a slight improvement over the 6.9 billion euro shortfall previously. A marginally smaller deficit can be a modest positive for the euro, indicating that either exports are picking up or imports are easing. Again, the low-impact label keeps this from dominating headlines, but it's another piece of the Eurozone puzzle. Moving to today's calendar, the first item is a low-impact speech from Federal Reserve Governor Michelle Bowman. While a single comment isn't likely to move the dollar dramatically, any hint about the Fed's stance on rates or inflation can nudge sentiment. Traders will be listening for clues on whether the Fed remains hawkish, dovish, or signals a pause in policy adjustments. Next up, China's consumer price index year-over-year is forecast at 0.8%, down from 1% in the prior month. A lower CPI suggests easing inflationary pressure, which could give the People's Bank of China room to keep monetary policy accommodative. For Forex traders, a softer inflation reading often supports a weaker yuan, but the impact rating stays low, so any move will likely be modest. Also on the Chinese side, the producer price index year-over-year is forecast at 3.9%, slightly below the 4.1% seen previously. A dip in producer-level inflation can signal reduced cost pressure for manufacturers, which may translate into lower wholesale price growth. Again, this is a low-impact release, but it adds to the narrative of a cooling price environment in China, potentially influencing the yuan's short-term direction. Now let's tie into headline news. U.S. July non-farm payrolls came in at a surprise negative 23,000, far below the consensus estimate of an 80,000 gain. The miss sparked a noticeable drop in the greenback as the market digested weaker labor market momentum. Analysts point to the disappointing jobs data as a possible signal that the Fed may have more flexibility before tightening further, which can keep the dollar under pressure in the short run. That wraps up today's market snapshot. Looters. Yesterday's low-impact data painted a picture of modest easing in Japan and Europe, while today's calendar gives us a few more clues from the Fed and China, and the U.S. jobs miss is keeping the dollar on the back foot. Remember, this is educational analysis, not financial advice. If you enjoyed the update, hit subscribe and ring the bell for tomorrow's quick take. Stay sharp, stay curious, and keep looting those market insights.